Good morning, doctor. My name is Wang Xinyi and my identity number is 298790. Today, I'll be presenting my credit risk management assignment titled The Effect of Internal and External Factor on the Credit Risk of Thailand's Bank Industry from 2014 until 2023, a case study from Kasikornbank. Now, let's have some background of Thailand bank sector and Kasikornbank. The Thai banking sector is a key pillar of the country's economy, regulated by the Bank of Thailand. Major players like Kasikornbank, Bangkok Bank, and Siam Commercial Bank offer service in retail banking, corporate finance, and fintech. In recent years, the industry has evolved from traditional banking to digital innovation, with mobile apps, e-wallets, and cashless payment becoming the norm. Despite the global economic challenge, Thai bank remains strong, supported by high capital buffers, diversified asset, and digital strategies that promote stability and financial inclusion. Kasikornbank or K-Bank is one of the Thailand's leading commercial bank, serving individual, SME, and corporate clients. Its core service includes saving and current account, loans, credit card, and foreign exchange. KBank has also expanded into digital banking with its widely using K Plus apps, offering user convenience, access to banking, investment, and lifestyle features. Beyond retail banking, the bank is active in wealth management, insurance, and cross-border trade service, with a strong focus on innovation, customer experience, and sustainability. KBank has established a regional presence in China, Vietnam, Laos, and Indonesia. Now, let's move to problem statement of this study. Credit risk is an inherent challenge in the banking industry, and it directly affects financial stability. At Kashkan Bank, recent reports show a rising number of non-performing loans, especially in the SME sectors. Alarmingly, even financially stable borrowers are beginning to default. Trade tensions drive this trend. Structural weakness in the corporate sectors and low consumer liquidity, all of which contribute to increasing credit risks. In response, KBank has introduced debt restructuring and extended repayment plans, but the urgency for stronger credit risk management is growing. There is a need to rethink lending strategies and improve asset quality to navigate this challenging environment. This study aims to investigate the factors influencing Kasikornbank's credit risk from 2014 to 2023. The three objectives are: first, to identify the internal factors affecting credit risk; second, to identify the external factors contributing to credit risk; and third, to analyze how both internal and external factors together affect Kasikorn's credit risk. To guide this study, we developed three research questions. First, is there a relationship between internal factors and the credit risk of Kashkon Bank? Second, is there a relationship between external factors and the credit risk of Kashkon Bank? And lastly, how do internal and external factors jointly influence Kasikorn Bank's credit risk? In this slide, we review both internal and external variables that influence credit risk based on ascertain literature. Credit risk refer to the likelihood of borrower default impacting financial stability and bank performance. Now, let's starting with internal factors. ROA measures profitability and shows a negative relationship with credit risk, meaning higher ROA tends to reduce risk. Liquidity risk reflects a bank's short-term financial health. Poor liquidity increase credit risk, so the relationship is positive. Loan ratio represents the proportion of lending. As it increases, exposure to defaults also rise, again the positive relationship. This slide presents eight internal variables and their relationship with credit risk. Loan loss provision, equity multiplier, leverage, and capital adequacy ratios show a positive relationship, meaning that as this value increase, credit risk also rise. On the other hand, debt to equity ratio, debt to asset ratio, risk weighted asset, and regulatory capitals have a negative relationship with credit risk, indicating the higher ratios are associated with a lower credit risk. Loan size and bank size have negative relationship with credit risk. This is because larger bank tends to manage risk better. External variables, which also as macroeconomy variables such as GDP growth, inflation, interest rate, and exchange rate volatilities influence the credit worthiness of borrowers. Economic instability increases default rates, thereby raising overall credit risks. In this study, I used a quantitative research approach to examine the credit risk of Kasikornbank from 2014 to 2023. The data was collected from Kasikornbank's annual reports for internal financial variables and from macroeconomic databases for external factors such as inflation and interest rate. Three regression models were developed. The internal models, which focus only on internal variables like RA, liquidity risk, loan ratio, and others. The external models were include macroeconomic factors like GDP growth, inflation, and unemployment rates. The combined model, which integrates both internal and external variables to assess their overall effect on credit risk. The dependent variable is credit risk, measured by the ratio of non-performing loans to total loans. All data was analyzed using SPSS version 29 with statistical techniques such as descriptive analysis, correlations, regressions, ANOVA, and coefficient testing to examine the strength and significance of each variables. This structural methodology allowed for a clear comparison of how internal and external factors contribute to credit risk. This slide presents key descriptive statistics for Kasikorn Bank from 2014 to 2023. The average credit risk was 0.52% with very low variation, showing stable loan performance. Our average 1.25%, indicating consistent profitability, while liquidity risk was 15.383%, reflecting solid short-term coverage. The bank loaned out about 66% of its assets, showing an aggressive but stable lending approach. In terms of leverage, DER was high at 7.03, and DTAR shows consistent use of debt at nearly 88%. CAR coverage 18.58%, well above regulatory minimums, and RWA remains stable at 77.73%. Externality GDP growth averaged 3.02%, and inflation was more volatile at 1.48%. Interest rate and exchange rates remains mostly stable, and unemployment rate was very steady at 5.82%, reflecting a strong labor market. Overall, Kasikorn Bank shows strong internal stability across the decades, even as external economic conditions shifted moderately. This slide presents the correlation analysis between Kasikorn Bank's credit risk and various internal and external factors. The results shows the ROA, liquidity risk, loan size, LLP, DER, DTAR, EM, IGCAP, leverage, CAR, yield curve, reserve money, and M1 has significant correlations with credit risk. Among these, liquidity risk, loan size, loan loss provision, equity multiplier, regulatory capitals, leverage, capital adequacy ratio, and M1 show positive correlations, meaning that as these variables increase, so did credit risk. This reflects that poor liquidity increases leverage and excessive provisionings often signal raising credit risk. On the other hand, ROA, DER, DTAR, yield curve, and reserve money shows negative correlations, suggesting that profitability, strong capital structure, and macroeconomic stable help reduce credit risk. All of these correlations were statistically significant with p-value below 0.05, confirming their relevance to credit risk profile of Kasikorn Bank. Now, let's move to model summaries. This slide summarizes the performance of the three regressions models used in the study. The combined model, which include both external and internal factors, produced the highest adjusted R-squared value of 0.992 or 99.2%, meaning it explains nearly all the variation in Kasikornbank's credit risk. However, only 8 out of 24 variables were actually significant predictors. The internal models perform almost as well, with an adjusted R-square of 0.990 or 99%. In this model, 6 out of 13 variables significantly contribute to explain credit risks, while the rest has no effect. In comparison, the external model has a much lower adjusted R-square of 0.647 or 64.7%, meaning external factors alone explain less than two-thirds of change in credit risk. Still, 8 out of 11 external variables were found to be statistically significant. Overall, this result suggests that internal financial factors are stronger and more consistent predictors of credit risk than external macroeconomic factors. The next slide is ANOVA. This slide presents the ANOVA result used to test the overall significance for each regressions model. In model 1, which include only internal variables, the p-value is 0.001, which less than 0.05. This means the model is statistically significant, and the internal variables taken together explain a significant portion of Kasikornbank's credit risk. In model 2, which includes only external variables, the p-value is 0.417, which is much higher than 0.05. This indicates that as a group, the external factors do not significantly explain the changes in credit risk. Finally, in model 3, which combines both internal and external factors, the p-value is 0.065. Although the model shows a relatively good fit, it is only marginally significant, meaning the combined variables may explain credit risk to some extent but not strongly enough to be statistically confirmed. Overall, ANOVA results reinforce that internal factors have the most statistically reliable impact on credit risk. Here is the result from the coefficients tables, highlighting which variables significantly influence Kasikornbank credit risk. In Model 1, which includes internal factors, ROA and risk-weighted asset has a negative impact on credit risk, meaning that better profitability and lower risk-weighted exposure reduce risk. Loan loss provision and capital adequacy ratio had a positive and significant impact, showing that higher lending activities, provisioning, and capital strength are closely linked to increased credit risk. Liquidity risk, although positively related, was not statistically significant, aligned with other studies that find its link to credit risk to be weak and inconsistent. In Model 2, which tests external factors, none of the variables, including GDP rates, inflation, exchange rate, and unemployment rates, was statistically significant. All through some variables like inflation and yield curve showed directional effect, their p-value were above 0.05, meaning these macroeconomic factors do not meaningfully explain credit risk on their own in this case. Finally, in Model 3, combining both internal and external variables, capital adequacy ratio and liquidity risk shows moderate positive significance, while M2 and M3 was also had weak positive effect on credit risk. Conversely, inflation, interest rate, exchange rate, and reserve money had weak negative significance, but their impact was minimal. Overall, only a few variables in these combined models had clear individual significance, reinforcing that internal factors remain the stronger and more reliable predictors. This finding confirmed that credit risk is most directly influenced by internal performance indicator, especially profitability, asset quality, and capital strength. Now, let's move to the conclusion of this study. This research set out examine the internal and external factors that influence the credit risk of Kasikornbank over the period from 2014 to 2023. Among these three regressions model tests, internal, external, and combined, the internal model stood out in terms of statistically significance. Although the combined model has the highest adjusted R-square values, indicating the best overall fits, many of its variables were not individual significance. This tells us that the internal factors play a more dominant role in shaping credit risks. More specifically, return of asset, loan loss provision, and the capital adequacy ratio emerged as the most influential predictor of credit risk. These were not only statistical significance in the coefficient table but also show strong relationship in correlations analysis. Additionally, we found that certain variables such as liquidity risk, bank size, and M1 has positive correlations with credit risk, while others like ROA, TR, DTAR, and the yield curve were negatively correlated. In summary, Kashkan credit risk is largely shaped by how well it manages its internal financial structures, especially profitability, capital strength, and provisioning policies. To improve credit risk management, this study recommends a few key actions for Kashkan Bank. First, the bank should focus on enhancing return of asset by improving operational efficiency and tightening credit approval to reduce non-performing loans. Second, loans provisioning should be strengthened using predictive analytics. A forward-looking approach can help the bank respond proactively to credit risk threats and reduce earning volatility. Third, maintaining a healthy capital adequacy ratio is essential. This involves preserving core earnings, manage dividend payouts cautiously, and optimizing the structure of risk-weighted assets. Beyond internal strategy, Kasikorn Bank must also integrate macroeconomic monitoring into its risk management processes. Regular stress testing on inflation, interest rate, and M1 growth can help the bank anticipate external shocks. Lastly, the bank should consider investing in a more integrated credit risk system, one that combines both internal and external indicators to support real-time decision making. For future research, expanding the study to include multiple Thai banks and use quarterly data would improve the model sensitivity and generalizabilities. That's all from me. Thank you for listening, and I hope you have a great day.